Have you come across terms like coupon, yield to maturity, or credit rating and wonder what they mean? Are you someone looking for stable money income from your investment but find fixed deposit interest too low and stock market volatility too risky? Well, there is a solution: bond investing. Bond investing was once successful only to the institutions and high net worth individuals, but in the past 5 years, platforms like Windwell, Zerodha, and Golden Pie have made bond available to retail investors like you and me. While this platform open up the exciting opportunities, it is critical to understand the risk involved because choosing the wrong bond without understanding its fundamental can be costly. In this video, we will deep dive into what is a bond, benefits of bond investing, limitations and risk, how to identify the right bond for you. So let's get started. What is a bond? Imagine you have a friend who owns a coffee shop who needs 1 lakh to expand his business. He can either go to a bank and pay 15% interest or borrow money from you. He offers to pay 12% interest over next year in exchange for 1 lakh investment. It's a win-win situation for both of you. You earn a better returns than a fixed deposit. He secures a loan at a lower interest rate. This arrangement is similar to bond. A bond is essentially a loan from an investor to a borrower, typically a corporation or a government. In return, the borrower pays interest called a coupon and the returns a principal amount at maturity. Let's see what are the benefits of bond investing. Predictable income until maturity. You get the same interest until maturity, which was agreed between borrower and investor. Capital preservation. The capital is preserved, that is, you get the full capital on maturity or as agreed between the investors and borrower. This is unaffected from market fluctuations. Diversification. This acts as a hedge to stock market fluctuation. Tax benefit. Some of the bonds, like municipal bonds and tax free bonds, offer tax benefits. Limitations of bond investing. Interest rate risk. Bonds are affected from falling interest rates in secondary market. However, this may not be a concern if you are holding till maturity. Credit risk. This is one of the biggest risks when it comes to bonds, as borrower may default. Liquidity risk. While most of the bonds could be sold in secondary market, you could end up in a situation where there is no buyer. There are two types of bonds popular among investors. Government bonds, issued by the national and state government and related government organization, often considered less risky but offer less interest. Corporate bond, issued by the companies, higher yield but higher credit risk. How do we identify the right bond? Understand your risk appetite and select the right bonds. When you select the high risk bond, always look for short term bonds and possibility of liquidation in secondary market. Thoroughly understand the financial health of the company. If the company is on the verge of bankruptcy or consistently giving the bad result, this could be the red flag to avoid as your entire capital is at risk. Look at the history of credit rating for the borrower to understand the borrower trustworthiness. Constant degrading from the credit agency could be the red flag. Always look at the yield to maturity while purchasing bonds to understand the actual return to know if you're buying a bond in discount or a premium in secondary market. It is a powerful concept in bond investing. It tells you the total return you can expect if you hold the bond until maturity. I hope this video provided you some basic insights into bond investing. If you find this video useful, please share and like. Please also subscribe to the channel to get more such interesting videos. Thank you.